welcome. You're watching Your Money Matters here at NDTV Profit. I'm Mahima Vachhrajani, and today the first topic that we're going to talk about is as to why top performing mutual funds don't remain top performers always. A lot of people who assess mutual funds go ahead and chase one-year returns, which is not the right way to look at mutual funds per se. And to explain exactly why, we are joined by Kumar, who's the CFA and Managing Partner at Zvest Financial Services, joining us now. Harsh, thank you so much, first of all, for taking out the time. My first and foremost question to you with regards to this topic is that should, first of all, a person chase one-year returns? Because according to me, that's a very small time frame to understand as to how the fund could have performed. Because if the markets are doing very well, the fund would have definitely performed well, right? I think from a larger time frame, I think at least 5 years should be considered. Is that something that you would also agree with?
Hi, Mahima. Thank you so much for having me. Now, let's start with a data point which should make every investor pause. If you look at the recent study which was released by DSP, over last 12 years, they have figured out that 67% of the top performing funds fall out of top quartile within 3 years. So if you're buying a fund basis last 1 year's performance, then the odds are stacked against you even before you click the button purchase. So this is in our language called recency bias. It's like, you're driving a car by looking at the rear view mirror. You can see exactly where you have been, but that's rarely what the future ahead of you lies. So if you are already invested in the market and you are selling your existing holding to buy last year's top performer, then I'm afraid you will have to keep repeating this cycle. So yes, it may happen that, last 1 year performer may perform this year as well, but the probabilities against you, if you are looking at it for next 1 to 2 years point of view. So my suggestion would be, yes, you're right in saying that one should look at a little longer term view. It should be considered over one market cycle rather than looking at just last 1 to 2 years. Having said that, as an investor, what you should do before you decide which fund to invest in. So there are two kinds of parameter you can look at, and both should be looked at in coherence. One is qualitative parameter, where you look at the depth of the fund management team, the strength of the fund management team, what is the kind of pedigree and research they bring on table, what is the kind of processes and transparency they have, even the integrity of the fund management team should be looked upon. And then there are quantitative factors where you have performance, where you have standard deviation, volatility, risk-adjusted return. And lastly, you should also look at your temperament. So your temperament, your profile, what you are looking from the fund, what is your holding period, what is your return expectation. You should blend that along with qualitative and quantitative parameter to arrive at which fund to invest in rather than looking at last 1 to 2 years return, because performance table will keep on changing every year, while processes and the underlying quality does not change that often in a fund.
Got it. So we talked about just last 1 or 2 years return, but Harsh, overall, do you think that checking past performance is the right metric to kind of assess a mutual fund? Here I'm talking about, other factors not being changed, just past performance. Would you recommend that, or no, that's not the right way to assess a mutual fund?
So it is a very, very important variable and it should be checked. But it should be checked over one market cycle. So there is no point being in a fund which has been quartile 3 and quartile 4 over the complete market cycle. Then there is no merit in having that, because you are investing in the market for getting the return. But that is just one of the variables. And there should be other variables also which should be kept in mind before you select the fund. And I'm sure you would be asking about those, and we'll be discussing those during the course of our conversation.
Right. Got it. So okay, understood. This is a completely, well put point. But Harsh, the other factor is that a lot of mutual funds that have been doing very well for certain years then stop giving those performances, right? How should one keep that in mind? What should one look at, especially when somebody is choosing a mutual fund for the first time, considering this aspect?
So one thing is that no mutual fund can perform or outperform over an extended period of time. And there is a technical reason for that, because when a fund starts performing, it becomes popular, it starts getting higher AUM. The deployment is not as fast as you start getting the AUM. And in that process, there is a drag in the fund. And that's the reason you should be very careful about tracking those things. Having said that, when you're looking at the basics of the fund. So like I said that, it's not just the quantitative parameter which you should consider. You should give equal importance to qualitative parameters. Now, the problem what I see with SIP investors or DIY investors is they just look at the performance. They don't look at the volatility which is associated with those funds. They don't even look at whether there has been a continuity in the fund management team. They don't even care about whether if there is a change in the fund manager, is there a backup at the fund house? Is there a process orientation at the fund house level? Because, you may have a good 6 months or 9 months and then there is a change in the fund management and then you are stuck in that fund for an extended period of time. Right. So to avoid all these things, you should have a holistic view of the fund rather than looking at just one or two matrices. And that's where I think professional help is required. You can do it at your end also, but you need to dig deeper. You need to do a little more exhaustive research than what we normally would do by just looking at the past return.
Got it. So this is about the first time, right? The first time when you go ahead and invest in mutual fund. But when you've already invested in a certain mutual fund, for somebody who's not tracking it actively, right? You generally invest in mutual funds for passive income, right? So then do you think that, what is the right time period or time horizon within which you should, kind of keep checking as to what's happening, especially with regards to qualitative aspects, right? When you mentioned that if the fund manager itself changes, then the ideology is changed completely and it may not match with what you thought of in terms of where your ideology stands. So how should one go about that?
So first thing first, in good old days, we used to say buy and hold. And that used to be, the narrative over the market. Yeah. But now we feel it is not buy and hold. It should be buy and watch. Though you are investing for a passive income, but market is disruptive. The changes in the world are far more faster and far more ferocious than what they used to be, say, 5 or 10 or 15 years back. So whenever you are investing, there should be an endeavor at your end to keep tracking the portfolio at least on a quarterly basis. Now, when I'm saying tracking, it does not mean that you see underperformance in one quarter and you say that, look, I'm going to exit out of it. You can stay put. You can look at the parameters as to why the fund has underperformed. Now, if the underperformance is because of randomness of the market or because of irrationality in the market, then you can stay put because market is not always rational. But on the other hand, if the underperformance is because of flaws in the processes or because of poor stock selection at the fund manager level, then definitely there is a reason for you to reconsider whether you want to stay put or not. Honestly, if you ask me, if the fund management team is taking 60 to 70% right bets, and if the weights in those bets is appropriate, then I think you can stay put in those funds for an extended period of time as well. But on the other hand, if those matrices are not falling in place, if the hit rate of the fund manager is 20-30%, and even in those 20-30%, the weights are very, very less, then I think you should reconsider whether you want to stay put in that or you want to change your strategy.
Okay. The other aspect, Harsh, that I was just thinking about is to a lot of these rating agencies go ahead and rate mutual funds, right? There's CRISIL, Morningstar also does that. How reliable are these ratings? Can you just blindly go ahead and invest in their top-rated or top-ranked mutual funds, or what do you suggest?
So one thing is that each rating is different. So I can't put everything in the same line and say that, these ratings are good or bad.
Yeah.
But before you rely on rating, you should understand the basic calculation methodology of those ratings. So if the rating is giving too much of emphasis on last 1-2 years performance, then definitely that is not a reliable rating. But if the rating parameters have both quantitative and qualitative. And this, maybe I'm boring your viewers by repeating it, but qualitative parameters are equally important as quantitative parameters. Now, one of the pitfalls of the rating, what I come across is that when some funds start featuring as top star rated, then DIY investor or even certain advisors start recommending those funds. And when the speed of inflows in those funds is far higher, and this we discussed earlier also, then what the fund can absorb, then you reach a situation where ratings start becoming a drag on the portfolio. So if the opportunity set is available, and the inflows are coming in the fund and the rating is higher, fund manager can still do justice. But if opportunity set is shrinking and the inflows are coming because of rating, then it could be detrimental for the fund.
And no, Harsh, it's a valid point. You're not at all boring our viewers. I think it's a valid point to put that qualitative aspects also need to be considered, because a lot of investors don't take into that consideration. So it's a very valid point, right? The other one that I had in my mind was that a lot of people also frequently keep changing their mutual funds. And over a period of time, they end up kind of investing in the same mutual funds, holding the same stock. So there's a lot of mutual fund overlap, right?
Right.
Do you think that's right to do in the first place, like frequently changing what mutual fund you're investing in or you're doing SIP in?
So one should not frequently change unless there is a strong reason to do that. Now, we always say that, too much of switching in investing is like sitting in a leaking boat. You may keep rowing harder and harder, thinking that you're putting in a lot of effort, but small leaks keep destroying your journey. So first thing first, it has to be a thought after carefully planned switching. Now, when should you do the switching? When you feel that the mandate in which you invested in is not being honored, you should switch. When you feel that the correlation of funds in your portfolio is becoming very, very high, you should think of reducing certain allocation and changing those allocation. And when I say that in layman terms, it means in a bull run, all your funds are doing well. In a bear market, all your funds are doing bad. Then that is not a good allocation strategy which you should have in the portfolio, because whenever you switch, there are two, three classical problems which happen. One, at times you may end up paying exit load. If not exit load, you are definitely going to pay capital gains. Even if you say that my capital gain is less than 1.25 lakh and I'll not have a capital gain tax implication, there is a behavioral pitfall which comes into place. You sell today, market goes up tomorrow. You feel that let the market come back to the previous level, which is called anchoring bias. And at that point of time, I will invest. And at times you may miss that opportunity altogether. So if you consider these two, three things, I would say that compounding is better when it is interfered the least, and compounding gets spoiled when you do too much of tinkering. Having said that, it does not mean you should not realign your portfolio. Like I said earlier, if there is a strong merit and if there are reasons which warrant you to change it, and the reasons could be a fund house changing its fund managers, which you don't like in terms of ideology, fund house itself getting sold, and you are not comfortable with the new fund management team which is coming into place, or the structure of the market has changed and the fund is not changing itself in terms with the needs of the market, then also you can realign your portfolio.
Got it. Okay. Just one last question, Harsh, from mine. Do you think that a large AUM being managed by the same fund manager could affect his performance and the fund's performance?
Now, like I discussed it earlier, what happens when a large AUM? So there are technical and fundamental reasons. Let's look at the technical reason.
Yeah.
When the funds start performing, it starts featuring as top-rated fund in most, websites and in most newspapers. Investors start rushing for that. Now, if the intensity of the flow, and this we discussed earlier also, is moderate, and the fund management team is able to deploy that, then there is no harm on the fund. But on the other hand, if opportunity set is low, inflow is far higher, then there is a problem. Let me give you with an example. If I look at small cap universe, and small cap is often talked about in terms of the flows it received, between 2015 and 2025, in a period of 10 years, the market cap of small cap increased from 5 lakh crore to 44 lakh crore. Now that is a 9x jump. Now in the same time period, if a fund grew by 3x or 4x in small cap universe, there is no problem because the universe is increasing at 9x and you are increasing at 4x pace. You are fine. You can manage, you can find out qualitative opportunities there and you can deploy the money. But on the other hand, if the fund is increasing at 15x pace and the opportunity is increasing at a lower pace, then there is a problem. There are two more disadvantages which I would want to tell investors about when they look at the bigger fund. One is that sometimes when the funds become too big, they start becoming benchmark hugging. So active share in the fund reduces. So fund manager sitting on 60, 70, 80,000 crore may not be playing that kind of an active share, which a smaller fund may play. So that could become a disadvantage. Second, the essence of the category may get lost. So today I look at certain flexi cap fund, which has become pseudo large cap fund. We look at small and mid cap fund, which have got allocation, which is far higher of large cap than what they should ideally run. So you are investing in a small cap fund. mid-cap fund, flexi-cap fund with a certain thought process, but in the end, a large part of the money is going into large cap, which is not a healthy scenario. So if all these pitfalls can be avoided, then I think larger AUMs can be managed effectively, and you should not overly worried about it. But if there is a concern on the parameters which I discussed, then definitely you should be out of that.
Got it. Harsh, thank you so much for taking out the time and helping us understand this entire concept, and of course speaking with us at NDTV Profit.